Good morning. This is a pack of stevia. I used to actually consume a lot more sugar, but now I use this stevia. Have you ever tried this? It's like sugar, but it's 0 calories. And I was talking to a friend of mine one time. He's a doctor, Stanford educated guy. I assume he's really smart. And he was actually the best man in my wedding. And he said, have you heard of stevia? And this was a long time ago. And I'm like, no. And he was living in California. Or I guess no, he's no longer in California, but anyhow, he says, "You should try stevia because they just changed one little molecule in the stevia. It's a natural plant, and the molecule it goes the opposite direction when it spins rather than like sugar. So when that happens, it doesn't digest in your system, but it tastes like sugar, and it doesn't create any carbohydrates or calories. You should check it out." And that was a long time ago. I finally checked it out. But anyway, the price of sugar, I'm just using this as an example, is likely to go up quite a bit. The price of things are likely to go up. And the only reason I'm bringing this up is because Ray Dalio, if you're not familiar with Ray Dalio, he came up with a article that he wrote, and he posted it on LinkedIn. You might look it up. It's actually called, the name of the article is "Why in the World Would You Own Dollar Debt?" But before we actually talk about this article, let's have a sip of coffee. Mm, I really need that. We've had a time change, and I've also moved. I'm in California right now, so it's earlier than normal for me. But anyhow, this article, I thought we'd talk about it because if you've been following us and me for a while, you've known that I've been talking about this concept of how the bond market doesn't make any sense. But I've always tried to be a little bit, kind of sugarcoat it and wrap it. And I think Ray Dalio did a really good job because he basically said owning bonds is stupid. Now, I don't think I've ever heard Ray Dalio say that owning something is stupid. That's a pretty big statement. Now, I belong to an email group of top analysts that just, talk about different things, and he's one of the gentlemen. I won't bring up his name. You might know him. He brought up this article and he said maybe he's just talking his book, meaning that he's out of bonds already, so therefore he's talking his book. And if you don't know who Ray Dalio is, I'd Google him. He's got tons of money under management with his company. But I don't think that's the case. I don't think it's that he's talking his book. Maybe, but I really think what's happening is he's just telling the truth, because the question is, why in the world would you own dollar debt? Now, when he says dollar debt, he's talking about bonds. I'm just pulling up the interest rates right now. Give you an example: 10-year Treasury rate. Holy schmoly! I didn't realize that. Okay, 10-year Treasury rate, it's 1.62%. Okay, it's up a little bit from where it was. The 10-year Treasury index rate is minus 0.62, so that's the inflation index security rate, is negative. A 30-year mortgage right now is 3%, right? So if you start looking at what bonds are paying you, you go, wow, that's not really paying me much, right? The prime loan rate's at 3.25%, but the A-rated corporate bonds, so that's bonds issued by corporations, is 2.01%. So I guess the point is, when you think about it, is like when you invest, you're investing to put some money aside now so that someone can consume money later. So you want it to grow. And if you're going to put money away for 10 years, do you really want to earn 1.5% or just over 1.5%? Isn't that really kind of stupid? I mean, come to think about it. And then one of the things that he goes on to say that I think is really interesting is he says the economics of investing in bonds and most financial assets has become stupid, which I think is amazing that he said that. The world is substantially overweighted in bonds and other financial assets, especially in the US, issued by the government. And because the government is producing enormous amount of debt, bonds just don't make sense. Basically, I'm summarizing, because they're devaluing this worth of these bonds. Now, this is something we've been talking about a lot. And to see somebody like Ray Dalio, who is a public figure, I mean, he's in Davos, he's become more of a public figure rather than just a private hedge fund manager, owner of a hedge fund, uh, because he's got much more of a spokesman mentality now at this stage in his life. For him to come out and to say this is really, to me, a huge signal. And we've all known it. Us in the business, we were like, wow, this is like really crazy. And we're thinking stupid in our head, but we're not saying stupid. But I mean, I'm looking at our investments that we have we have some bonds. We still hold bonds because we're trying to preserve some of those assets from market volatility for certain clients. So he makes the point that you just got to buy stuff. If bond prices fall significantly, that will produce significant losses for holders of bonds, and it will encourage them to sell. So he's making kind of this point that there's going to be this self-reinforcing process of bond prices go down, and then people who own bonds decide to sell them. They make the bond prices go even further down, and you could have this cascading value in bonds. And there is a ton of money in bonds. And I remember when I first realized that the bond market was stupid. And it's actually been a long time because bond prices have been stupid for a long time. You probably have heard of Bill Gross and the PIMCO funds. The PIMCO funds was, and maybe they still are, the largest bond manager in the world. And I've, over the years, watched them gather assets in bonds. And I remember when this single bond fund hit the $1 trillion mark. So there's $1 trillion in this bond fund. And I'm like, can you believe there's $1 trillion in this bond fund? And it made me realize, wow, this is crazy. This is stupid. And that's where we are right now, Ray Dalio. And it got worse from there, right? So that's where we are right now. Now imagine what would happen if for some reason all these bondholders decide they're going to sell them. It made me realize, okay, well, we know that China owns a lot of our bonds. And what I thought of something that was interesting because a lot of people don't realize this, but we've had some skirmishes behind the scenes with China. I mean, they shot down one of our satellites with a rocket, and then we shot down, I believe, 7 of their satellites down, and it was all quiet. So it's like, hopefully you realize that we can shoot your satellites down too, so there's some definite things that are going on behind the scenes with China. And guess what? They own a ton of our bonds. Don't you think they want to get rid of them at some point? I mean, okay, so the US debt and credit, he makes this very logical statement. He says history and logic show that central banks, i.e. the Fed, when faced with supply and demand imbalance situations that would lead interest rates to rise to more than is desirable in light of economic circumstances, they will print money to buy bonds and create yield curve controls to put a cap on bond yields and will devalue cash. So he basically is using a lot of jargon there, but that's saying what I just said earlier: print money. And then he adds on that they're likely going to try to print that money, but then they're going to try to buy it up, so that to make the illusion that somehow everything is okay by buying those bonds and keeping those yields lower. Well, guess who did that for a long, long, long time? Japan. And what happened in Japan's economy? Not good, right? So I guess the point is that we probably still have way too much bonds on the books in America, in the United States. And a lot of people's money is at risk, and their portfolio should be reviewed. And you have to have a place to put it. That's the other part of it. Where are you going to put this money? Recently, we've been buying even more agriculture because agriculture trends have started to move higher. But he says buy stuff, and any stuff that won't be devalued. So that would imply that real estate will appreciate relative to bonds. That would imply that stocks will. It will imply that really all real assets will. Gold will, silver will. Um, there's also, he makes some a little bit of a discussion about the pandemic. but he makes a point that the government is likely to kind of try to hurt capital flows. This is the big one that I think people are not talking about. So I'm just going to read his main point on this. He said that based on both how things have worked historically, and this guy Ray Dalio is a huge history fan. I mean, he really has studied how the economy works under various economic circumstances. He said, based on how things have worked historically and what is happening now, I'm confident that tax changes will also play an important role in driving capital flows to different investment assets and different locations, and those movements will influence market movements. That's a nice way of saying that we're going to get taxed higher on certain things to and people will start moving around money to avoid losing a lot of money to taxes. And he also says different locations. That would imply different countries too. Now, he goes on to say if history and logic are to be a guide, if history and logic are to be a guide, I think that's a really good guide, by the way. Policymakers who are short of money will raise taxes and won't like these capital movements out of debt assets and into other storehold of wealth assets and other tax domain. So they could very well impose prohibitions against capital movements in other assets, example, gold and Bitcoin, and other locations. These tax changes could be more shocking than expected. Duh. This is the thing that, that could be really, really, really bad. And whenever I talk about this to people, even amongst our team, people look at me like you're crazy. That's never going to happen. Ray Dalio is saying that right now, and I think he's right. He's finally. I'm not sure why he. It would be great to have him on. Boy, wouldn't that be amazing to be able to interview him on this? But maybe he'll talk more about this. But what he must have gotten a lot of strength, I guess, to come out and say this, because it's a pretty bold statement to say the government's likely going to be putting prohibitions on your capital. Now, the reason why I'm saying that with emphasis is because capital is a big thing. Capital is more than just the government spending. Capital is a much bigger number. It's the capital stock that supports the whole economy. And when you start having big movements in wealth assets like that, it affects lots of things. It affects currencies, it affects asset prices, and people's fortunes will come, either go way up or go way down. So he talks about Elizabeth Warren, who wanted a wealth tax, blah, blah, blah. But he says he thinks this is a new paradigm. For these reasons, I believe a well-diversified portfolio and non-dollar assets, along with short cash positions, is preferable to a traditional stock and bond mix that is heavily skewed in the US dollar. I've been saying this. I've been saying that you don't want to invest like your parents. You can't invest like your parents. This is a different world. And there's more to it than just what he's talking about. This is just one element. There's also the whole innovation and creative destruction, a disruption that is occurring now. You combine an economy, a technology revolution that is creating innovation and disruption, and you combine that with a government that's doing this economic scenario, you cannot invest like your parents. So he says, I also believe that the assets in the mature, developed reserve currency countries will underperform the Asian, including Chinese, emerging countries. I've been saying that. We've been saying that. We've been overweighted emerging markets because that's kind of what's happening right now. We're becoming at an economic disadvantage relative to emerging countries. I also believe that he goes on to say, I also believe that one should be mindful of tax changes and the possibility of capital controls. Absolutely. Absolutely. We're in a situation where the government must do some pretty big things to try to hold it together. So we're prepared for this, just so you know. We are prepared. We feel like we're prepared. We've already made moves in this direction too, but we still probably own too many bonds, trying to keep the volatility down. So if you haven't looked at your portfolio, I highly, highly recommend look at your portfolio and get it in a position where you are prepared for what's happening here. Ray Dalio is not the kind of guy that just spew this kind of stuff out. So I'm glad that he said it. And I'm glad that you heard this. And if you need a portfolio review, let us know. Email us at info@wealthnetinvest.com. Put that in the show notes or the comments. info@wealthnetinvest.com. So your portfolio should not look like the way it normally looks. You should have a different view on how you put things together. So I'm really getting excited because I'm going to meet a friend of mine, a new friend of mine that I just met when I was in South Carolina, who is also an author. And we're going to talk, we're going to have some fish, and we're going to talk about what's going on with his book. He's got a very interesting book about imprints in customer service. He's really big on how to give world-class customer service and consulting companies in doing that. And I just got off the phone with a publisher yesterday. It looks like, hopefully, if all goes well, the publishing of my revised edition will be coming very, very soon. We'll have a platform. We'll keep you in on that. But if you came in late, watch this video, because what we talked about is very, very important. And I commented about Ray Dalio's article that just came out. All right. That's all for now. I'm going to have one more sip here. You guys have a very good day, and we will talk to you tomorrow.